school levy credits, and then investment strategies. Thanks, guys.
Yeah, you bet. Good afternoon, everybody. As John said, Erik Kass, Director of Public Finance. See a lot of familiar faces on the screen, so it's a pleasure being here today. A lot of you were there in January where we talked a little bit more broadly about the school levy credit. As I thought about this follow-up discussion, we're certainly going to talk about the school levy credit just for the benefit of those that maybe were not in attendance, because I do think it's a very important issue for practitioners across the state to understand. We're not going to go into as much detail as we did in January, given only about 20 to 25 minutes here today. But what I also wanted to do is kind of augment the idea and kind of spark some thinking related to kind of the philosophy of what I call property tax levy or mill rate management. And there's some core principles related to that, and they're kind of interwoven in some respects, but also each of them kind of stand alone on their own merits. And really what I hope you can glean or pull out of this discussion is maybe a few thought-provoking ideas as you enter into budget, preliminary budget discussions and tracking towards ultimately, which will be your certification of your levy this fall. Just maybe a few ideas that you can contemplate as it relates to, thinking a little bit more long-term as it relates to the taxpayer and the levy strategies that you might have. So with that, Matt, if you want to click next. So what I'm going to show you is this is actually real school district data. I did call it ABC. I pulled it from a recent referendum package that we put together for one of our clients that's going here April 2nd. But I'm going to step you through just kind of how some of these strategies can kind of play themselves out and talk a little bit about some pitfalls that you may want to think about. So as Matt goes on to the next slide, this is an actual school district that has really not done anything related to property tax levy or mill rate management. And when we're looking here at the total levy for the school district dating back to 2011-12, you can see it's fairly choppy. Some years they might have a little bit increased enrollment. We all know for most of this period of time, there wasn't a lot of per pupil increase. So per pupil increase really isn't causing a lot of that. There's probably some shifts in the pot of money they received from state aid, for example. But you'll see that there's a lot of ups and downs. If you go to the next slide, the same data brought through on a mill rate looks certainly different, right? The choppiness is simply downward. And more recently, you can see from 2021 through 23, there's been some significant declines as it relates to the mill rate. But I think therein lies what I'll talk about here in the next coming slides is the difference or the bifurcation of the two approaches when we think about the mill rate versus the tax levy. And I think that this has become very clear in the last 2 to 3 years, just across the state of Wisconsin, when we've seen what I would consider hyperinflation related to home values, commercial values, and things of that nature. And so I think we need to be very careful, and I'll show some information related to targeting a mill rate in this day and age, because really what we're doing is lifting our levy higher than maybe we would like to, and really the burden of that is going to be on the homeowner that's seeing sometimes 10 to 15% valuation increases in their home value, which is great because if they were to sell their home, it's going to be worth more. But when somebody's not selling their home, their property tax bills are going up. So a little bit of that, and I'll unpack that commentary here in a minute, is really related to trying to avoid a pitfall of some angry taxpayers calling about why their tax bills have gone up 10, 15% when you're communicating that the mill rate hasn't changed. So if we go to the next slide, I'm going to interject, keep going here, what I would consider a tax levy management. So if we just look at that same data that I showed earlier, and we think about a school district that might have some Fund 39 or referendum approved debt. So that is the example I will use. Community Service Fund 80 is another fund that is outside of revenue limits that you can play with a little bit, but it's very strict in terms of its purpose, and the DPI has a very scrutinized eye upon that. So I'm going to use the example of a school district in this case that has actual Fund 39 debt. So under Wisconsin state law, you are able to levy on an annual basis up to and including all of your outstanding principal and interest. Now, there's rarely a school district, unless they're close to retiring debt, that's ever going to execute up to that limit. But what I'm showing here is an idea and a concept that a school district could maintain a flat levy, especially in those years in orange that otherwise they would have a declining levy for 2019-20 through 22-23. So each year that orange bar is a little bit different. And the positive of this is twofold. Number one, you can make that determination as you get towards November. Obviously, I would always recommend doing some pre-education with your board and community about that idea, concept, and the intent and purpose of doing it. But as you get your final equalization aid numbers, as the third Friday enrollment comes through, and everything becomes clear from a revenue limit perspective, and you're close to certifying your levy, this really can be a strategy where you're plugging in an additional levy amount above what you would levy to cover your principal and interest the following calendar year to, again, maintain that flat levy. So it can be a key strategy to help smooth out that levy. And really what it also does is it allows you to kind of inflate that levy, purpose being to pay off debt early, which is many times when I have those public discussions with school boards, they really like, because you're retiring debt that might be structured over 20 years. You might be reducing it by upwards of 5 to 10 years. I have some clients that have shortened a 20-year amortization down to 10 years or less just by using a levy management strategy. So it can be very good news. And then one other piece before you go to that, go back, Matt, is that when you get into 23, 24, that orange bar doesn't need to be there. So it can help smooth you out on the upward trajectory. So if you're, for example, a low revenue school district that got the advantage of the $11,000 minimum on the revenue limit, you could have been facing, and maybe you were facing, a pretty significant general fund property tax levy. You know, if you were a district that for a few years was doing this additional levy in Fund 39, the sweet spot is really, you can let that drop off. You really only need to levy again your minimum principal and interest every November. So those orange bars can become flexible. So if the blue bar is growing, the orange bar can pretty much go away and consume a portion, hopefully all of any of those small increases when you're looking at your general fund on an annual basis. Now, go ahead to the next one, Matt. So this levy strategy certainly is different because even in this case, the mill rate is significantly declining, right? And again, there's that cross between or difference between the tax levy and the tax rate. So because of that hyperinflation, even though they're matching their levy, their mill rate is still dropping over time. So in some respects, you know, when I talk to school boards about this type of strategy, it is a win-win in many respects because you're being mindful of the property taxpayer. You're not increasing the total levy. The mill rate is declining over time as values are going up. Tax bill should, removing the noise of the school levy credit, which I'll talk about, you know, they pretty much should be the same from one year to the next. And you still have a good news story of your mill rate declining over time as well. Flipping to the next slide, we certainly have some school districts. A lot of recently pivoted into what we call a mill rate or a tax rate management strategy. So if you flip to the next slide here, what we're looking at here is a school district that would do the same thing on the Fund 39 debt levy. I'm sorry, it's footnoted wrong. It's not the all fund mill rate, but the orange bar is additional levy in terms of a mill rate. And you'll see that we flattened out the mill rate. So what it was in 2018-19, we've continued that mill rate all the way through. But flipping to the next slide, what you're going to see from a levy perspective is an upward trajectory, right? So therein lies the difference. And just one thing that I would really want to stress is be very thoughtful if you're going to do a tax levy management strategy on what type of approach really fits and understanding some of the moving pieces, because I can tell you that in 2021, 22, and 23, you're going to have property taxpayers that are going to receive significant increases in their tax bills because, again, the mill rate is really balanced off by the hyperinflation on property values, most of which is on the inflation side of home values increasing over time. And when you're increasing your levy to support a flat mill rate, really what you're going to be doing is you're going to asking homeowners and commercial property taxpayers to pay more on an annual basis. So, you know, I consider this the potential angry taxpayer calls that come in December. So I just wanted to run through that really quickly, the first 5 to 10 minutes here before I get into some specific strategies. But if you could go forward then, Matt, into the next one. So strategies that provide opportunity. So in the next 10 to 15 minutes, I'm going to kind of fly through some 4 core areas that we really focus on and give you a little bit of insight on each. So click to the next one. Easiest one is state aid. So every July 1, get a state aid estimate. There's winners, there's losers. Every district is different. At that point in time, I always stress that it's just an estimate based on budgets that were submitted, actually being spent and received on the way they're submitted. But I can tell you that if you look at historical data, it has been fairly close unless you're really in an outlier of underspending or overexpending your budget. So if you're a district that's going to be kind of close on what you submitted to the DPI, you're probably going to be within a 5% margin of what that July 1 aid estimate is. So for those school districts that are increasing in state aid, there's that opportunity, because the offset to that is, of course, more state aid is decreased general fund tax levy, and will provide you some opportunity. Again, I want to be careful to stress that it is just an estimate, and editorial comment in this day and age with the DPI being where they're at, there's less and less trust in terms of some of those estimates, but it is at first blush a good planning tool for you to consider, looking at what your levy might be doing in the general fund as it relates to some tax levy management strategies. Next. The next one is equalized value, right? So annually, August 15th, municipalities certify their values to the Department of Revenue. They do not equalize them, meaning that they don't equalize them for every school district, but we are able to gather. And sorry, just real quick side note, this presentation will be sent over to John, and he is free to send it out to all of you. So these links are live, and it'll take you right to the Department of Revenue, where you can look at all of your local municipalities from this past August. But the point being is that we built a tool, going into the next slide, Matt, for school districts specifically, that coming out probably within a day or two after those being certified, that really provide a good solid estimate for property value increases, which is a key component for really what you're thinking about as it relates to your levy and your mill rate. So this is never going to be exact, because again, it is not equalized. But when we've done this for the last 3 years, we've really found that we're probably within 0.05 to 0.1% difference on the total growth factor for the majority of school districts. There's always a few outliers with reassessments and stuff like that that might fall out of bounds for district boundaries, which is really the biggest impact to this type of analysis, because it's certified by municipality. And when you might cut through a municipality and a neighboring district might cut through, we don't always specifically know where the growth is, but just a nice tool for you to have early in your planning process to begin to understand early on, way ahead of the October 1st equalized certified values, what you might be looking at from a planning standpoint. We build this for all 420 school districts. If you don't have a tool like this at your disposal, you can just reach out to myself or Matt, and we're always happy to provide that to anyone in the state of Wisconsin that needs it. You can also go through the link and kind of do your own analysis, but if you like to be efficient, feel free to reach out, and we're more than happy to send that along. So next slide. So this is just Verona School District. This is just Oregon. Of course, they have very hyperinflation. You can see in the blue box, which is going to bleed into the next, the third kind of strategy, we're looking at unpacking that growth. So for Oregon specifically here, we projected their growth was 16.13%. I think they came in at 16.05%. But one of the interesting things that we're able to do now is to unpack that, because every school district has two factors that kind of roll up into a total growth. One, which is easy to understand, is inflation, right? It's the existing properties and what the local assessor or the Department of Revenue places on there for market pressure inflation. So high demand, a lot of times we're seeing high inflation for home values. So that's really what that big number is, 13.75. But then another kind of historically hidden variable is something called net new construction. So for Oregon School District, you see there, it's estimated at 2.38%. And net new construction, what that term means is it is properties that are coming on the tax rolls for the first time in that calendar year. So simplifying that, it's properties that have never paid taxes before, but will be paying taxes for the first time in that calendar year. So it's really kind of this interesting variable of, from a tax levy management standpoint, and how every taxpayer will see their bill at the end of the day, and what you can do to take advantage of that. Now, I want to stress that unlike tech colleges where they receive certified net new construction, every municipality, of course, receives certified net new construction because they encapsulate it in and submit it to the Department of Revenue to become certified. that's not really certified for school districts. So it's never going to be exact because, again, going back to my example of a school district that might cut a municipality, we don't always know with the data on where the growth is. So there always is a back and forth with a local practitioner and trying to understand if a large portion of the growth we identify in any community might be in a neighboring school district, or if it's like, hey, I know that a new supermarket is being built in my boundaries, and that's really what's coming on the roll. So, I think it's a good estimate type of discussion. So pivoting into that as a specific strategy, if you could go, Matt, what we do is, again, linked there is those are certified every year on August 15th as well. So it's data that is readily available. And as I already highlighted, it's like those properties that have never paid taxes before. So that'll be, again, a live hyperlink. If you click it, it'll take you right to previous year's report. It's really nice. It's all in Excel. You can kind of pull your own municipalities out of there and do the same thing. But again, we're always happy to provide that because we build it for all schools. If you get into the next slide here, and I'll talk about how we use this. What we're looking at here is, I'm not sure which school district this is, probably Verona, but we really look at providing a 5-year history of the breakdown in a summary format. So inflation obviously is in black, and then every year that estimate for net new construction kind of flows, and then we have a 5-year average of 2.87. So when we think about tax levy management strategy and looking at this specific example, when on August 15th, we project 3.72% net new construction growth, what a lot of our clients are saying is, what my total levy can actually increase by 3.72%, or maybe 90% of that just to be safe, whatever they're comfortable with. And really, at the end of the day, no property tax bill is really going to deviate very significantly from the prior year. Because again, an increase to the total levy, in this case of 3.72%, really is going to be consumed by those new property taxpayers that have never paid before. So they're really starting at a zero-sum game. And then their first tax bill would be in line with every other property taxpayer. You can get there again by manipulating your Fund 39 levy. Just another underlying strategy that I find interesting that a lot of our clients are using on an annual basis to build that capacity to pay down debt early and plan for kind of smoothing out and, future priorities, whether it be capital or operational referendums. Jump to the next one. So this is just the same thing for a different school district, because again, every school district is different in terms of their breakdown of inflation and net new construction. Now to the school levy credits. So I got about 5 or 6 minutes, which I apologize for. So I'm going to fly through a little bit of this. But when we think about, increases to your levy, we see those over on the left, right? We know what most of those variables are. I'd even throw like voucher schools in there now, even though they might get decoupled here in the future. But certainly there's some pressures on increases to your school levy. Decreases, of course, I talked about equalization aid, but then after the tax levy is certified, there's a significant pool of money, $1.2 billion, that's coupled into that school levy tax credit. Go ahead. So equalization for school levy credits. So very quickly, equalization aid is provided as a embedded piece of your final levy certification. So when you're communicating, your board's approving, equalization aid, whether it's going up or down, is going to impact what your final school levy, especially for your general fund, is going to be. Levy credits are different, where they're ultimately providing property tax relief on the actual tax bill. So these are funds that are given to the local municipality, and the local municipality, through their wizardry, and I can tell you many times is incorrect from our research and evaluation, they apply a certain amount to every single tax bill, aligned to the school line item of a tax bill that decreases ultimately what is collected or from that property owner in relation to the school district that is certifying a levy that they're required to pay. Go ahead. So both equalization aid and school levy credits are included in the calculation of 2/3 funding by the state. This is an interesting concept, right? So there's always, the devil's always in the details. So every year when they talk about their funding towards public education, they couple together not only equalization aid, but also the school levy credit. So I think that that's an important piece of this, because when we get to the end of this, ultimately you need to decide, as I talked about in January, whether or not to entertain the concept of talking about this as you go through your budget process. And I think this is a very key piece because the legislature communicates it as though it is part of school funding. So I think it is very relevant to bring it into the conversation around how you are funded and how kind of your property tax levy is really impacting the local property tax or homeowner or business owner in your community. Go ahead. Matt?
Did it not go? Sorry, I hit it. Sorry about that.
There you go. So the purpose of equalization aid, I think we already know this. So it's to minimize the differences among school districts' ability to raise revenues for educational programs. Now, this is not to start a debate on whether or not it's equalizing or disequalizing, but that's of course ongoing since the advent of not only revenue limits, but equalization aids. But at its heart, that's really what equalization aids were intended to do. Go ahead. It's supposed to be targeted really property poor, low spending school districts. Intention is to have them receive more state support. Obviously, there's a lot of school districts that might have very high property values, but are very low spending, low socioeconomic. So it doesn't always work out the way that we intend it to. But again, that's really at its core what it's supposed to try to accomplish. Go ahead. School levy credits, on the other hand, are really targeted at property wealthy, high spending school districts receiving more state support. So how do they do that is school districts and how the levy credit is doled out. It looks at the levy for every school district over the prior 3 years. So we already have, and John has our estimate for the school levy credit for the fall of 24. Because again, it's based on the certification of your levy in 23, 22, and 21. And so when you think about that, if your levy is extremely high, meaning that you get very low state aid because you're property rich and high spending, you're getting a lot more on the school levy credit. So it's almost opposite in terms of its approach, not in all the detail, but from a macro sense, it's really intended, again, to target high levy school districts as an underlying, I would call it, hidden strategy to drive down, the local property tax bills for those high taxing school districts. So when we think about the gross and net property taxes, so it's kind of bracketed in both ways, right? So total allowable revenue limit formula, we all go through that process. State aid is an offset to that, and then we certify our levy. We have a little bit of squishiness on, Fund 39, as we talked about, Fund 80. But at the end of the day, we're really certifying a tax levy that's very much dictated by the number of kids, the per pupil amount, and whatever amount of money we get from the state aid. What happens after the fact, so you certify your levy, you give it to all of those municipalities. They then do their calculations based upon the pool of money that they're allocated for the school levy credit, and they provide what we would call a net property tax. So again, when you look at a property tax bill, it shows 22 and 23, school district, municipality, tech college, blah, blah, blah. The school number is actually decreased by the amount of the levy credit that's applied on an annual basis. So it truly is embedded in that specific line item, different than the lottery credit, for example, which takes all of the taxing jurisdictions, the total at the bottom, and then removes it from the total. This one actually removes it from the specific K-12 line item. Just another editorial comment as to why, the legislature and the system is really set up to be aligned to school districts. Go to the next one. So school levy tax credit data, it's not provided to school districts for consideration when setting the tax levy. So therein lies kind of the complexity of this, right? So because it happens after the fact, a lot of school districts have shied away from even entering it into the conversation because it's really hard to go through an education process, not only with your school board, but potentially your community, to get them to understand we are approving a $10 million tax levy, but at the end of the day, it's really only $9 million. And here's what it actually means to you, right? It's a little bit of a leap of faith for that reason, as well as the fact that it's always going to be an estimate with reasonable accuracy. Upward pressure on the tax levy and the large increase in the levy credit in the state budget make this estimate more and more important, right? So this last year in 23 was the largest increase to the school levy credit since the start or the outset of the school levy credit in the 90s, which I think speaks volumes for how the legislature views it as a tax relief strategy targeted where they want it to be targeted. Final point is school leaders and boards would benefit from understanding the levy credit, and you should locally decide how best to use this information. I think there's certainly some school districts we work with that I'll show you here in a second that have thrown caution to the wind and said, we're going to bring it into the discussion, we're going to show it, and we're going to work through it. But there's other school districts that have avoided it, and then there's kind of some in the middle that are raising awareness but not necessarily calculating its impact. Go ahead. So finally, as I alluded to, this is just one interesting thing that we worked with one of our clients. So Verona, I've shown a bunch of their data. The reason being transparency here. I'm doing this in next week at the accounting conference for WASBO. So a lot of this content is going to be used again, and I'm doing it with 2 practitioners. So what they did is they started with this table and they said, okay, their levy increase from the prior year is certainly an increase, the tax impact, and their percent increase was on their levy was going up 8.6%. Net new construction for them was 3.72%, which again is a reduction because a portion of the increase of 8.6 is going to be shouldered by those new property tax that have never paid taxes before. And then they brought in the school levy credit increase. So they actually took their estimate and backed it down to 75% to be cautious, and that got them a 4.88%. And so at the end of the day, what they presented to their board and their community is, yes, we are going to be certifying an increase to our levy of 8.6%, but we are confident due to these 2 factors that they explained in more depth, you're going to receive a 0% average tax impact. Every property is going to be different, but on average, it's going to be minimal ups and downs. But over in the aggregate, it's really going to be no local individual property homeowner or business owner impact when you get your bill here in December, which I felt was kind of a very simple approach. Obviously, there's a lot more rhetoric that goes around it, but I really like this table in terms of how they kind of broke it down and unpacked it to kind of get to the actual impact of what their levy really was going to be looking like for their community. I think that might be my last slide, Matt, unless I'm mistaken. It might be kicking back over to you.
Nope, that would be the last slide.
So I know that was a lot, but kind of turn it back over to you, John, and see if there's any questions or anything.
Yeah, thanks, Eric. Well, and looking at this chart, I'm wondering for districts that don't typically get a levy credit or much of one, low income, low value, property value, low spending districts, you could potentially put the equalization aid change in there and in that lower number, right? Would that be valid?
I mean, you could, but it's already embedded in your levy increase because again, it's coming in through the formula. So that's kind of the difference, right? Is it happens naturally as part of your levy certification versus kind of after the fact, which, the net new construction and school levy credit.
Sure. Okay. Other questions from folks? You feel free to just unmute yourself and turn on your camera. I'm not seeing anybody. All right.
All right. Thank you.
Yeah, thank you. And Eric, I was just reflecting on the presentation that you gave at the school boards conference, and you had some statewide data that I think I'd love to have you back because that stuff was, I think, very interesting from a sort of a political standpoint for AEF members and how we might use that. And so maybe when we talk about this for our next market update, Eric and Matt can both come back again and we can look back at those other figures. That would be interesting.
Yeah, and just one last thing, John, I did send you the 420 school districts estimate, so you can certainly share that with all members, or if anybody would like their estimate, they can just flip me an email. Happy to give you kind of our projected school levy credit estimate so you can, have plenty of time to think about whether or not it's advantageous to begin discussions in the future or not.
Yeah, super. Thank you. That's very generous. Really appreciate your time and expertise, Eric.
Yep. Take care, everybody.
Take care.
Bye.
Well, Matt, interesting things going on in the market, huh? Wow, lots to talk about today. We're not. Do we still have an inverted yield curve and crazy wacky things like that, or what's going on?
Yeah. So I appreciate you having us on, Eric. Like I said, had to get on the road, but he did a great job. But we're going to shift gears, like John said here. Talk just a little bit about the markets, sort of the things that we're seeing here. First and foremost, though, I do want to just kind of emphasize the fact that it starts with cash flow. If you don't have one, there are lots of places that you could probably obtain one. Really, the first step is just to define your comfort zone. Make sure that you have ample liquidity for everything. If you don't have liquidity, absolutely do not invest. Number two is assess
Matt?
the state statutes. And yes.
I'm just going to have you speak up a little louder because
Oh, sure.
it's not really picking up the mic. Thank you.
All right. That might require me to get closer to the camera as well. So I apologize to everybody watching.
No worries.
So number two, assess state statutes and district policies. Just always make sure that what you're looking at is allowable and fully transparent. You don't want there to be any secrets and misunderstandings about what it is that you're actually investing in. Number three, analyze the markets. If you don't have the ability to analyze the markets yourself, you can lean on somebody. There are a lot of professionals out there that are willing to help. And the last one is invest to your liabilities. So just you need to make sure that you provide for ample liquidity to make sure that you can pay, AP and payroll and stuff like that. The three tenets that we always talk about, that the state treasurer always talks about, is safety, liquidity, and yield. Cash flow, it's super important for investing, but it also can be really useful for just administrative planning purposes. So first up on the list, though, we're just going to talk a little bit about CPI. So the graph you see here is CPI over the last 30 years as of the end of January, I believe. So it's actually changed a little bit. For those of you that don't look a whole lot at CPI, CPI, or the Consumer Price Index, compares the value of a market basket of goods and services versus historical pricing, and then includes things like food and energy prices. But I want to talk about something that's a little bit different than that today. And I think we talked about it a little bit on our last call too. That's something called core CPI, which is used more often to measure long-term inflation trends. And it does that by removing these short-term volatility items like food and energy. CPI as of February was at a 0.4% increase, which was just a little bit higher than what I think a lot of people actually anticipated. And while that's not ideal, I don't necessarily think it tells the whole story either. Because there's one other component that doesn't get removed for core CPI, and that's something called owner equivalent rent. And basically, it's a housing component, and it's notoriously difficult to price year over year. And this is a cost associated with, of course, housing. And I just kind of want to pause for a second and talk a little bit about what that means for this CPI and how much of a massive impact it's had on this. And so I mentioned that as of February, CPI was at about 0.4%. Going back to the start of COVID, if you can kind of get through that COVID time warp a little bit with your mind, people really stopped moving. All right. And so what that means is that the amount of listings dropped precipitously. They really haven't returned quite yet to where they were pre-pandemic, and with more people working from home, there's a lot less reason to uproot. So would-be home buyers felt those impacts almost immediately, just with the limited options that they face in the market and higher prices. But if you fast forward to 2024, we've seen some fairly consistent job growth, despite wages not really keeping up with a lot of key indicators. But when jobs are hot, people do move to where those jobs are located. And so with a stoppage in housing growth because of COVID, we were left with a hole of available housing. And when demand covers supply, prices go up. Established homeowners have been far less affected by these changes. In fact, they've been reaping some of the benefits, with about $2.2 trillion in housing wealth being added to homeowners' balance sheets since early 2022. But renters and new buyers are really struggling to find what used to be once affordable. And so that's a really significant component of CPI in this calculation. In fact, if you exclude it, which some people recommend doing just because of its complexities, CPI would sit around 2.2% year over year, and core CPI would be around 1.9% year over year. So more or less right on target with kind of where we like to see it. And with where we are today from where we were about a year ago or even 6 months ago, you can see that the Fed's expectations have really sort of come in on the federal funds rate range, which is kind of one of the key drivers in these interest rates that you see and talk about and use on a daily basis. So if you're looking at, where are we here? So September of 2023, we were looking at, you know, perhaps being around 3.88% a year from today. Now we're looking at being somewhere closer to about 3.6%. So that's really a change in about 3 months that we've seen the Fed actually becoming a bit more hawkish, perhaps, in identifying some of their path forward. The federal effective rate range today sits at a 5.33%. So exiting 2024, you can probably estimate that that's going to be somewhere around the 4.5%. And what that really is the federal effective rate is it's the interest rate that is part of the dual mandate of the Fed. Basically, their job is to control maximum employment and to control interest rates. And so they use those two things really to control inflation, which is what we're here talking about today. And so that kind of shows itself in, this is one of my favorite graphs here. So this is a dot plot from the Fed. This comes out on a quarterly basis. In fact, John, next year we might need to just kind of bump this meeting to early April, and then we can do so maybe another week with our fall one, just because they're going to come out with another one of these dot plots here in about a week. But what you see here is a vote. Every one of these dots represents a vote from a member of the Federal Open Market Committee in where they see interest rates going for the foreseeable future. So you see 2024 into 2025 here. And then beyond 2026, they just call it the longer term, and you kind of return to that 2.5% interest rate, 2.5% inflation range that is beneficial for the economy. In some ways, the market's struggling for direction. Obviously, CPI is higher than expected yet, but the S&P is also at a record high. A lot of people are talking about AI right now. So companies like NVIDIA and Alphabet and Meta, there seems to be this sort of bubble that a lot of people are sort of talking about within, they call the Magnificent Seven. They're the seven companies that have really been driving the gains in the S&P this year. But these three in particular are driven by AI. I was reading last week a piece in the Wall Street Journal kind of about these three companies and how this bubble is perhaps not even existent at all, because the markets as a whole have improved so much that these companies really are in some ways less valuable today than they were a year ago compared to where the market is. And that's just really interesting, because it should be somewhat comforting as well, because obviously a bubble of three of the major companies in the S&P never makes anybody comfortable. Another thing that is striking me as interesting right now is the issues that we could see coming up with like longer distance supply chain. We all have really bad recent memories of supply chain issues, I'm sure, but Boeing has been seeing a lot of issues with their ability to produce the amount of planes that a lot of carriers are asking for. And so their shares have hit a fresh low this week after the initial Alaska air slide. They've got some production challenges and are beginning to, and those challenges are beginning to hit carriers. New airplanes are not being delivered at the same rates that orders are coming in. And I know some of these supply chain memories are a little short-lived, but some of them are also a little bit long-lasting, like the shortage of housing that we have here. So I guess we'll just kind of see where that goes. But one last thing that kind of is going to be impacting markets as we go on into the year is obviously the election. So historically speaking, the year prior to an election sees a lot of volatility in the markets. And it generally lessens the closer you get to that election day, because people are speculating, for that year ahead of time, what's going to happen and how it could potentially impact their company, and just the macroeconomic scale. We're not really seeing a whole lot of volatility right now. Volatility is actually pretty low for the last couple quarters. And that's just something that's super interesting. There's a lot of reasons perhaps why volatility is super low. But that's just a couple items that I thought are worth talking about. and perhaps could be something that we talk about, in the months to come. But the Fed themselves, they appear to be zeroing in on a path forward with cuts beginning in their June meeting. They continue to be heavily data driven, which I think is very good, because the last thing that we want to do is have them begin easing rates and then pause and then maybe have to hike back rates back up in the short term, because that would be a pretty devastating action, I think, for the economy here. So what we're looking at here is the U.S. Treasury yield curve. It looks nothing like a yield curve. In fact, if you can follow my mouse, this is sort of what the yield curve is supposed to look like. Just a nice soft curve up and outward. The gray line is where we were about a year ago. And you can see that between there and the end of the year, short-term rates obviously have come up. That's the Fed, changing rates, raising rates. And that most immediately affects short-term rates on the yield curve. Where we are today is the blue line. So we're not all too different from where we were a few months ago, but you can see this green dotted line here is where we expect to be a year from today. We expect that the Fed is going to be comfortable enough to begin easing rates, probably with probabilities today by the June meeting. There's about a 40% chance that they might do something at their April meeting. May meeting, but we're really thinking June and then on towards the end of the 2025 right now. And so this yield curve doesn't appear to be providing great opportunities, but liquid interest rates are still extremely high, and you can still find some mid to short term investments that are going to be providing opportunity, through a number of terms. And so what I have here, this is a comparison of FDIC yields at different terms, 6, 12, 18, 24, 30, and 36 months. And then the red line is Treasury yields. This gray line is the federal effective rate, Fed futures line. So this is essentially where liquid interest rates are expected to be given current probabilities and the current dot plot through a period in time. Now, it's important that you don't use these as a comparison. They should always be evaluated separately, and then you can make decisions. But really, the basis of this visual is just to sort of understand, hey, if I have the ability to invest out to 18 months, I could still conceivably be getting, 4.91% in some of the CDs available today. And that would be at maturity, 1.91% perhaps above where liquid interest rates are going to be. And so this is just kind of a way for people to discuss opportunities that they might have with their own personal investing, with district investing. And so it's still a great time to invest. There's always an investment rhetoric with every environment. Very rarely, if I'm honest, does that rhetoric involve not investing. But what changes between all of those environments is the context with which we need to discuss. The cash flow obviously is very important. And from that, we derive different recommendations. And so with those recommendations, we take them to the market and we see what's available, and then the districts, move forward as is best for them. So that's all I have here for sort of a market update. I guess I can take some questions if anybody has any. John?
Yeah, it's interesting stuff, Matt. Thank you. It looks like the soft landing that we had heard about is happening, huh?
Yeah, there's definitely a potential for that. I think, like I said, they're very data driven. The data is definitely there, but I think because the markets are really struggling for direction, they just want to make sure that they have everything in order before they begin moving, which is obviously intelligent. You don't want to move too quick. So
sure, yeah, and still 4.9% is a pretty nice yield.
it is. Historically speaking, these are some pretty significant investment rates. Yes.
So Matt, you're basically saying we should look at locking some things up a little long term if we can, because they're probably not going back up.
If you have the ability to, if you're looking at your cash flow and if the rates support what you're wanting to do, absolutely. I think it's a smart move right now.
Good. Other questions? We still have 17 folks on the call. Anybody else have questions for Matt about what comes next? Matt's magic ball. Well, it's good to hear about the interesting thing about Boeing too, you know, and looking at their challenges with meeting market demands, and doesn't the aviation industry kind of mirror sort of the market overall, right? Like if it's growing, just the economy is growing, then aviation is typically growing too, right, Matt? It's kind of a good indicator.
It's a very volatile industry.
Oh, is that right?
I mean, if you think about the safety concerns, and if you have, because I talked a little bit about the Alaska Air event, and that's really severely impacted Boeing from the day that it happened. And obviously, there's a ripple effect from that because it affects the company, which affects the employees, which affects their output, and that output affects carriers, which affects prices of tickets, and it affects the movement of goods. So there's just so much involved with it. It's a very unique industry.
Say a little bit more about the big seven or the lucky seven. What was the seven tech stocks? It was Meta, Nvidia.
Oh, so it used to be FANG, Facebook, Amazon, Netflix, and Google. So now it keeps changing over time. It's the Magnificent Seven, I think is what they call it. So you've got Facebook, Amazon, Google, Facebook is Meta, Google's Alphabet. They keep changing names too. I can't keep track with them. Netflix is on there. Amazon is on there. And then I believe Tesla is on there now as well. So it's just seven of the largest, most productive companies in the S&P, and they've really been driving the S&P. There's a lot of data out there that talks about how these seven companies have really been holding up the S&P as a whole through the last 3 to 4 quarters. And so it's just that's what it is. It's just the group of some of the largest companies out there.
Yeah, gotcha. Interesting. And so the idea being that even if there is a proverbial bubble among those seven, the feeling is that the rest of the economy is really quite strong.
Yes, the economy is in a really good spot. There's a lot of data that's come out recently. Jobs have been very consistent. Wages, I think everybody wants to see come up a little bit. But I think I mentioned it too. The bubble might not necessarily even be there because of the market as a whole has become so valuable over the last year that relative to the market, that those companies are actually a little less valuable than where they were a year ago, which is astonishing given the growth that they've seen. So what that really lends us to believe is that if in fact there were a bubble, it wouldn't be as impactful as many would fear.
Sure. Good. Well, that's good news. Always interesting stuff, Matt. And yeah, let's get back out in front of this sometime in September, October. I think, is there a Fed meeting in September, is it?
Yep, there's a Fed meeting in September. And if we could schedule the next one to be just after that, then we'll have some fresh data for you.
Yeah, that'd be great. And then that thing you showed about the voting of the Fed members, that would be interesting to get that. Is that in October, or when does that happen?
Happens quarterly. So they'll have one this week, and then they'll have one in the September meeting as well. So we'll have one a fresh one in September. This one is a couple months old. So.
Sounds good. Well, we'll get people kicked off with their school years and get their budgets kind of straightened out, prepped for their annual meetings, and we can have you guys back.
All right. Thank you so much.
Yeah, thank you, Matt. Appreciate it.
Take care, everybody. Thanks.
Thanks,
Bye.
everybody, for joining us today. And AEF is happy to help with all your financial questions on revenue limits and all that good stuff. I'll post this to our YouTube channel, and I will be uploading Matt and Erik's materials coming up in the next half hour or so. Thanks again, folks. Take care.